joined right now by a guest on the third quarter earnings season that's begun. So far, we've seen Alcoa, Marriott, and Pepsi beat expectations. Our next guest says that trend will continue. Bob Froehlich joins us now. He's Senior Managing Director at Hartford Financial Services. Bob, so glad to have you with us in the studio. Do you think we're going to see a repeat in the third quarter earnings season of the earnings beats, but at a cost? I mean, most companies did it in the second quarter, but they cut costs. They slashed costs, to be more precise. And they also didn't see any revenue growth.
That's a critical question. I mean, we know we're going to get the earnings number based on the cost cutting. I mean, the layoffs, the downsizing, the right sizing, if you will. And so far this quarter, it's sort of the mixed signal. I mean, Pepsi beat expectations, but they didn't have good top line revenue. Where Alcoa, not only did they beat expectation with cost cutting, but they beat on the top line. And so that's, I think, the real dichotomy for investors in this market. Don't be lulled to sleep to think everything is good just because they're beating expectations with the bottom line. You can only squeeze so much. You got to see the top line growing.
So should investors ignore the headlines, the earning headlines, and look at revenue growth and only be interested in stocks that are seeing sales growth and market share growth?
I think the headlines are old news, quite frankly. We've been cutting costs and laying people off and firing people for the last year. So if you're a company and you can't meet those numbers, you shouldn't be running that company at that point. I mean, with productivity at 6.5%, I could make money in most companies. So you have to look at the top line. So that's going to be the critical number. And I think the savvy investors will look at that number because they don't want to know what's happened. Don't tell me you've cut costs to make those numbers. Tell me what's going to happen going forward. And I think the revenue number is the best indicator.
We just brought our viewers that breaking news on the ECB leaving rates as expected alone. The Bank of England did the same thing earlier. The Fed has indicated rates stay low. Most economists are saying at least a year. That has to help corporations to a certain extent, right?
It's helping in a great way, especially the large multinational firms here in the United States. I think that's the sweet spot. There's very few things as an investor that you should look in the rearview mirror to get your clue. One of them is interest rate cuts because it actually takes a year. So, I mean, 43 countries have actually cut rates in 2009, which means the global economy is probably going to be on a good stage in 2010. The way you benefit that is with the large cap multinational firms deriving a majority of their revenue outside the U.S.
You like tech, financials, and energy as groups to invest in. Is that betting on the recovery? It seems that way.
That's betting on the recovery, and it's betting on a weak dollar. So our stuff is still going to be on sale. So a combination of recovery and a weak dollar, I think, are going to position them. And the financials a little bit. I think the yield curve gets steepened. With weak jobs, I mean, the Federal Reserve Board, they're handcuffed. They can't raise rates even if they wanted to. So steepening of the yield curve, that really helps financials as well.
And there's one sort of outlier pick that you like as a group. You say the luxury consumer is going to come back and come back roaring. How is that? Are you betting on Wall Street bonuses?
You have to be a contrarian on one thing. You know, this is my contrarian call. It's two parts to this. One is I really do believe we're going to see record Wall Street bonuses. I mean, the market has turned around. I mean, so things are up 50, 60%. So I think it is going to reflect it in better bonuses.
50, 60% up this year, maybe down 80% from last year.
I know. Remember, I said don't look in the rearview mirror on everything.
But it still has to even out.
It will, and I think what it'll do is it'll increase consumer confidence. But I think the bigger call on luxury consumer is I believe they always had the propensity to spend. They just lost money on paper. They were guilted into not spending. You know, go back a year ago, we thought the world was going to end. When you think the world is going to end, it's tough to spend $700 on a purse from Coach. But now all of a sudden, when you know the recovery, because now the debate is it a capital V, a small v, an L, a U, whatever letter we want to. But the recovery's here, so I think that bodes well.
Bob, don't you believe that the consumer generally wants to deleverage, so to speak? You know, we hear about companies talking about their balance sheets, but people feel similarly. Even if you're wealthy, you're facing pressures that you haven't felt before.
I think they do want to delever, but I think the delever will still drive retail, and I'll tell you why. I think the deleverage means we're going to spend money differently. So I would hate to be a retailer in the middle. I wouldn't want to be a Lord & Taylor right now, but I certainly would love to be a Costco. I'd love to be a Target, because people that never shop there, I think as they deleverage, they will continue to shop.
And you wouldn't mind being a Tiffany either?
No, not at all. Tiffany, Coach, I think you want to be the luxury high-end, the deep discount retail. I'm a firm believer that people in this country were born to shop. Well, they'll just shop differently depending on what the economic backdrop is.
And Bob, before we let you go, you have a pretty optimistic target for the Dow by year end. You say 11,000?
It's a really optimistic target. Yeah, I think it's going to break through 10 early on in this earnings season. And once it does that, I think that $4 trillion sitting on the sideline is going to say, I want to be in the market before next year starts. And plus, we're going to get a lot of window dressing in the fourth quarter from portfolio managers that missed this rally, and they're going to want to make sure they dress up their portfolio by the end of the year. So I think we'll be at or approaching approaching 11,000.
Bob, I'm sure there's a lot of people out there who hope you're right. We thank you very much for joining us. Bob Froehlich, Senior Managing Director at Hartford Financial Services Group.